Welcome to AC303. Today we're going to cover the statement of cash flows. Let's take a look at our agenda. We're going to talk about the purpose, the different sections within the statement of cash flows, go through the format, which includes the three sections: operating, investing, and financing. Within the operating section, we can prepare that section under two methods, the direct method or the indirect method. Then we're going to spend some time going through a demonstration problem that allows us to prepare the cash flow statement under both the direct method and the indirect method. Okay, first of all, let's talk about the purpose. Why are we putting together the statement of cash flows? Well, first of all, it's a required part of a full set of financial statements. And secondly, it gives information to investors and creditors about the sources and uses of cash. It also helps creditors know how the company is managing their cash. Are they generating enough cash from their core business to cover their liabilities? Are they growing? Are they buying a lot of property, plant, and equipment? Or are they shrinking and selling property, plant, and equipment? Those types of questions can be answered by looking at the statement of cash flows. The statement of cash flow also provides information about material non-cash events, which are shown in the supplemental notes. The next thing we'll talk about are the sections within the statement of cash flow. The first thing I'd like you to think about is this from a perspective of the balance sheet. So if you look at a balance sheet, you can see the beginning cash balance and the ending cash balance. So as of January 1, the cash balance was X. As of January 31st, the cash balance was Y. So let's just throw some numbers in there. So January 1st, we have a $1 million cash balance. 12/31, we have a $2 million cash balance. So there's a $1 million net cash inflow of cash during the year. The statement of cash flows, the whole purpose behind that is reconciling beginning to ending cash. So from an investor and creditor standpoint, they want to know, where did that $1 million come from? What are the net cash inflows and the net cash outflows to balance the cash account? This is where these three sections come in. Within these three sections, if you add them up, you're going to get the net cash change for the year. The statement of cash flow shows all the cash receipts, which are cash inflows, and the cash disbursements, which are cash outflows for a given period of time. When we talk about the operating section, here we're talking about the core business, which includes transactions reported on the income statement, as well as current assets and current liabilities. One exception to this rule is if we have some interest-bearing short-term notes or short-term debt, we're actually going to include that in the finance section. The next section of the cash flow is the investing section. Here we're going to show non-current assets. And again, we're looking at it from a perspective of what's the net change from January 1 to December 31st. That change is going to be reported on the statement of cash flows and all the transactions that surround that change. The next section is the finance section. Here, we're going to be concerned with long-term debt and any interest-bearing short-term debt, as well as equity. All right, next we're going to talk about the format. Here I've included a sample summarized format of the statement of cash flows. As you can see, the first section is net cash provided or used in operating activities. Hopefully, this is a positive number. Remember, the operating section is the core business. The second section has net cash provided or used in investing activities. This one typically is a negative number. Think about what we're putting in this section. We're putting long-term assets. So many companies are investing in long-term assets, so that's why this is going to be a negative number. The third section is net cash provided or used by financing activities. Depending on the company, this can be positive or negative. So again, if you add those three sections together, you're going to get to a net increase or decrease in cash, or the change in cash from the beginning of the year to the end of the year. In our example earlier, that was $1 million. So at the beginning of the year, we had $1 million in cash. At the end of the year, we had $2 million. So if you add the three sections together, you're going to get that $1 million. Then you're going to say, okay, well, at the beginning of the year, I had $1 million. If I add my change, or the net increase decrease, that other $1 million, I'll get $2 million, which is our cash and cash equivalent at the end of the year. So when we talk about cash and cash equivalent, this means actual cash plus any short-term liquid investments, which are usually 3 months or less at maturity. Okay, so let's go through the methods. And again, the methods only correspond to the operating core business section. The financing and the investing sections are exactly the same under both models. Both U.S. GAAP and IFRS encourage the direct method approach. It's interesting to note that 90% of companies use the indirect approach. Investing and finance sections are exactly the same under both methods. So how does the direct and the indirect method differ? Well, the direct method has major classification of operating cash receipts and disbursements. So by that, you'll see on the next page when we talk about it, we're going to see what was our cash that we got in from our customers. What cash did we use to pay for cost of goods sold? So those are the major classifications that we're going to show in the operating section of the cash flow statement under the direct method. Using an indirect method, it's really going to be a reconciliation, starting with net income. We're going to start at net income, and then we're going to make some adjustments for non-cash items or items that don't belong on the operating section. Here, I want you to take a step back and think about this from a very high level. Again, think of it maybe from a balance sheet perspective. If you have a balance sheet in front of you, 12/31 one year, 12/31 the next year. So you have a beginning of the year balance and an ending of the year balance. So if you look at the change from the beginning of the year to the end of the year, or 12/31 to 12/31, it's the same thing. If you're looking 12/31/2012 versus 12/31/2013, that's year-over-year change. So if you look at that over the course of the beginning of the year to the end of the year, and let's say our assets are increasing, that means we're buying more assets, which means we have a cash outflow. We're having cash go out the door as we're purchasing more assets. If our assets are decreasing, that means we're selling, which is a cash inflow. Then if you look at our liabilities and equities section within the balance sheet, if our liabilities and equities are going up, that means we're borrowing, which is a cash inflow. If our liabilities and equities are going down, we're paying off our liabilities, which is a cash outflow. Okay, so let's get into more details on the direct method. So again, with the direct method, we're going to have major classifications of cash receipts and cash disbursements actually presented in the operating section of the cash flow statement. So here are the categories that you're actually going to report separately. So the first 5 are going to be cash increases or cash inflows. The second 5 are going to be cash decreases or cash outflows. So the cash inflows are going to be cash receipts from customers, interest received, dividends received, other operating cash receipts, or cash received from sales of securities, classified as trading if they're classified as a current asset. All other securities will go in the investing section. Then if we look at the cash outflows, those are going to be cash paid to suppliers and employees, interest paid, income tax paid, cash paid to acquire trading securities if they're classified as current, and other cash payments. So all of these items are going to be included in the operating section under the direct method. So there's some formulas that we need to memorize and understand to be able to prepare the statement of cash flows under the direct method. So when we talk about cash receipts from customers, how we're going to figure that out is we're going to start with revenue. So we're going to look at the income statement and we're going to find out what are our sales, what are our revenue. This is going to be a cash inflow, right? Well, we know that we didn't get all that cash. Some of that was sold on credit, right? So then we have to say, okay, well, what was our net change from the beginning of the year to the end of the year in accounts receivable? If the net change was a positive number or an increase, we're going to subtract that. because think of it from a accrual standpoint. If all of our sales were on credit rather than cash, we're not going to get cash in. So if our accounts receivable has increased, that means we haven't received that cash from our customers. So that's going to be a subtraction. If we have a net decrease in accounts receivable, that means we have more cash from our customers than what we sold in credit. So that's a positive. Next, we're going to look at our change in unearned revenue. If that's a positive number, we're going to add that back to our revenue. If it's a decrease, then we're going to subtract it. We add all these up, we're going to get cash receipts from customers, which will go on the operating section under the direct method. Next, let's look at cash paid to suppliers and employees. If you look at cash paid to suppliers, we're going to start with cost of goods sold, and then we're going to make an adjustment for changes in inventory. If our change in inventory is a net increase, that means we're buying more inventory or we're using cash. It's going to be a cash outflow. We're going to add that. If we have a decrease in inventory, that means we're selling, which will be a cash inflow. We're also going to make an adjustment for a change in AP. So if our accounts payable has a net increase, we're going to subtract that because we're borrowing more, which is a cash inflow. If our change in accounts payable is a decrease, then we're going to add that back because we're repaying more, which is a cash outflow, which will get us to cash paid to suppliers. We'll use that same logic to figure out cash paid to employees. We'll start with salaries and wages payable, or salary and wages expense. And then what we're going to do is make an adjustment to that to changes in wages payable. If it's a net increase, we're going to subtract it. If it's a net decrease, we're going to add it back to get to cash paid to employees. So what we're trying to do here is go from an accrual standpoint to a cash standpoint. And then if you look at the bottom of the page, other operating cash payments, we'll start with other operating expenses and make an adjustment for changes in prepaid and changes in current liabilities to get to cash paid for other expenses. All right, let's switch gears and go to the indirect method. Here, it's really a true reconciliation. We're going to start with net income, and we're going to make some adjustments for items that don't either belong on the operating section or didn't really require any use of cash. So we'll start with net income for the income statement. We're going to add back depreciation and amortization. We're going to add back any losses. Again, if you think about this, gains and losses are going to be included in the net income number, but they really aren't attributed to the core business. So they don't belong in the operating section. They actually belong in the investing section. So here, we're making an adjustment for losses and gains by removing them out of the operating section and into the investing section. So we'll add back losses, subtract any gains, and then we'll subtract any equity earnings and affiliates. Again, this is part of net income, but it's not our core business. It doesn't belong in the operating section. The next two things we'll look at is the change in operating assets, which means our current assets. So any change in current assets, we have to ask ourselves, are they going up or are they going down? If our current assets are going up, then that means we're buying, which is a cash outflow. If they're going down, we're selling, which is a cash inflow. Next, we'll look at our change in operating liabilities, which is our current liabilities except any interest-bearing debt, even if it is classified as current. Again, that's going to go in our finance section. If our current liabilities are going up, that means we're borrowing, which is a cash inflow. If they're going down, we're repaying, so that's a cash outflow. Next, let's talk about the investing and finance section. So these two sections are exactly the same under both the direct and the indirect method. The investing section, we talked about this earlier, is really concerned with our non-current assets. So if you look at our balance sheet and you look at all of our non-current assets, we're going to have to make an adjustment for these on this section. If they're going up, that means we're buying assets, which is going to be a cash outflow. If they're going down, we're selling assets, which is a cash inflow. The next section is the financing section. Here, we're going to be looking at changes in long-term debt or current debt if it's interest-bearing, as well as equity. If they're going up, we're borrowing, which is a cash inflow. If they're going down, we're repaying, which is a cash outflow. And then just to note, any non-cash investing and financing activities are going to be included as a supplemental disclosure. Okay, so let's spend some time going through a demonstration problem. Please make sure you download the demonstration problem located in course module 8. I've included most of the information here, but it will help you if you download the actual problem. So the first thing we want to look at is the balance sheet. I've made this calculation for you, but typically if you're doing your homework, you're not going to get the difference column. You're going to have to calculate this yourself. Or if you're taking the CPA exam, this will not probably be provided to you. You'll have to do the calculation. So the first thing I do is I look at the 12/31/2012 balance, the 12/31/2013 balance, and I figure out what's the difference. Is my cash and cash equivalents going up or going down? And same thing with accounts receivable, inventory, etc. I'm going to use this difference column in a lot of my calculations. The next thing I look at is I look at the income statement for items that I know I'm going to have to make adjustments for. Then I look at the additional information. And I kind of make notes on how does this impact the income statement and how does this impact the balance sheet. And I kind of try to reconcile it with the information that's provided and make sure that I'm not missing anything. So let's go through the notes. And I've kind of made income statement balance sheet adjustments up on the top of the PowerPoint for you to see. So if we look at note 1, we have on March 22nd the company sold equipment with a book value of $50,500 for $60,000. The equipment was purchased for $80,000. So I tell myself, okay, what are the impacts to the income statement and the balance sheet for this transaction? From an income statement perspective, we know the selling price is $60,000 and our book value is $50,500. So we know I have a gain of $9,500. So I can reconcile that $9,500 by looking at the income statement. I have a gain on sale of equipment for $9,500, those balance. So I know that I'm not missing any transactions as it relates to the gain on sale of equipment. Next I say, how does this impact the balance sheet? So when we sell the equipment, we need to take the equipment off the balance sheet as well as accumulated depreciation, right? So we know we bought it for $80,000 and we can back into the accumulated depreciation because we know the net book value. And then we would have gotten cash in of $60,000 when we sold it, which gets us the gain of the $9,500. Next, let's look at note 2. On June 5th, the company issued 1,000 shares of common stock for $40 a share. So here I know I got $40,000 cash in. And then if you look over here on your common stock, it's a $20 par. So we know $20,000 or $20 times 1,000 is going to go to common stock. And we're going to plug the difference to additional paid-in capital. So you can see, if you look at the change year over year, common stock, $20,000. We know we have all the information. The additional paid-in capital changed $20,000. We know we have all the additional information attached to those two. So we know we're not missing anything. Okay, let's look at note 3. Here we have $100,000 in bonds were issued at par value on January 15th. So here we have cash in of $100,000 and bonds at $100,000. So if you look at your bonds payable, the change year over year is $100,000. So we know we have all the information that we need for the bonds payable. Okay, let's look at note 4. Here we have on December 1st, land and building were purchased for $250,000. The land was appraised at $80,000. So what we have here with this transaction is cash going out the door of $250,000, land at $80,000, and then we can plug the building at $170,000. Again, if you look at the balance sheet for land, we can see the difference from the beginning of the year to the end of the year is $80,000. And then the building and equipment are added together. And if you look at the Excel spreadsheet, you'll see the reconciliation of equipment, because here we need to take into consideration the sale of equipment in Note 1 as well as the depreciation. But all that reconciliation is done in the Excel version that you can download from the course module 8. Okay, so let's go on to Note 5. Here we have on October 1st, the company purchased stock in XYZ Company for $77,000. This is classified as available for sale security. Cash is $77,000 going out the door. Marketable security for $77,000. Again, reconcile it back to the balance sheet. We had 0 at the beginning of the year, 77 at the end of the year, so our net difference is $77,000. So we have all the information we need for the notes. We have all the differences, so we can go ahead and get started on putting together the statement of cash flows. Okay, the first one that we're going to prepare is the direct method. So let's look at the first thing is the cash receipts from customers. So if we're looking at the cash receipts from customers, I've included the calculations below. So you can look at the sales that will be included on the income statement, $700,000. And then we're going to need to make an adjustment for the change in accounts receivable. So the change in accounts receivable went up year over year, $44,000. So we're going to need to subtract that from the $700,000 in sales to get a net cash receipt from our customers of $656,000. That's going to show up as a positive number in the operating section under the direct method. The next one we're going to look at is cash payments to suppliers. Here we're going to start with the cost of goods sold that you can take directly off of the income statement. That's going to be a negative number because that's cash going out the door. Then we're going to make some adjustments for the change in inventory and the change in AP. So the change in inventory went down, so that's a cash inflow. The change in AP went up, so we're borrowing more, so that's a cash inflow. So the net cash payments to suppliers is $400,000, which is going to be a negative or a subtraction in the operating section. Then we're going to look at cash payments for SG&A. You can take that, again, directly off of the income statement. SG&A expense, $50,000. Then we're going to make an adjustment for any changes in accrued SG&A. In this case, we don't have any accrued SG&A at the beginning or ending of the year, so we don't have to make an adjustment. We can just take the $50,000 in total and subtract it. Then we're going to look at cash payments for interest expense, number 4. Again, we'll take that directly off of the income statement. Interest expense is $20,000. We would need to make an adjustment for any change in accrued interest. In this case, there isn't. So we'll take the $20,000 in full and put it on the operating section under the direct method. Again, this is a subtraction. This is cash going out the door. The final thing that we need to look at in this scenario is cash payments for income taxes. We'll take that directly off of the income statement for $40,000. We don't have any accrued income taxes, so we don't need to make an adjustment. So our net cash paid for income taxes is $40,000, which will subtract from the cash receipts we got from our customers. So if you add your cash receipts from your customers, subtract out your payments to suppliers, payments for SG&A, payments for interest expense, payments for income taxes, we're going to get a net cash provided by operating activities of $146,000. That didn't seem so bad, did it? Okay, so let's go on to the investing and finance sections. Here, we're going to use more of the notes that we put together. So, cash flows from investing activities. Now remember, the investing activities are the long-term assets. So if you go back to your balance sheet and go to your notes and think about the things that are changing, that are long-term assets, we're going to want to include those here in this section. So the purchase of available for sale securities, our note 5, that's going to be $77,000 cash out the door. And then our purchase of land and building, our note 4, that's $250,000 out the door. And then the other item that we need to account for here is the sale of equipment, which is our note 1. So we have, and remember, this is from a cash perspective. So we have $77,000 going out the door for our available for sale security purchase, $250,000 going out the door for our land and building purchase, and $60,000 coming in the door from our sale of equipment, for a net cash used in investing activities of $267,000. Next, we're going to look at our finance section. So with our finance section, remember, from the high-level view, we're looking at our long-term liabilities as well as our equity, and if we have any short-term interest-bearing debt. So here, we're concerned with our Note 2 and our Note 3. So we had proceeds from the issuance of bonds and proceeds from the issuance of stock. So we have $100,000 coming in from bonds and $40,000 coming in from stock for a net cash provided financing activities of $140,000. So if you go ahead and add up your net cash provided from operating activities of $146,000, subtract out your $267 net cash flow used in investing, add your net cash provided by financing of $140,000, you get a net increase in cash and cash equivalents of $19,000. Add to that your beginning cash and cash equivalents of $131,000 should get you to your ending cash and cash equivalents of $150,000. And you can check these by looking at your balance sheet. You can look at your beginning, your ending, and then the difference. If all of this doesn't balance, then you're missing something or you miscalculated something. So in some regards, the statement of cash flow is one of the easier things because you can balance it. You know that you're missing something. Okay, so let's go in. Now that we've done the direct method, let's look at it from an indirect method standpoint. Okay, so with the indirect method, remember we start with net income and then we make some adjustments for things that either don't require the use of cash but are included in net income, or they're things that don't really belong in the operating section because they're really not our core business. So here we're going to start with our net income of $64,500, which we can take directly off of the income statement. Then we're going to add back depreciation. We all know that we don't actually write a check for depreciation. It's a non-cash expense, so we're going to add that back. That actually didn't use cash. Gain on sale of equipment, we're going to subtract that out because that was cash in, which is included in our net income number, but that needs to be part of the investing section. Selling equipment is not part of our core business. Then we need to look at the increase in accounts receivable. In this case, our accounts receivable went from $200,000 to $244,000, or $44,000. So we need to subtract that out because we didn't actually get that cash from our customers. A decrease in inventory. So if you look at our inventory from the beginning of the year, we had $45,000. The end of the year, we had $32,000 for a net $13,000. So we're using more inventory instead of buying it. So we're going to add that back. And then we're going to look at our accounts payable. So our accounts payable at the beginning of the year was $110,000. The end of the year it was $197,000, so it increased $87,000. So when our accounts payable increases, that means we're not using cash to pay that down. So we're going to be borrowing, which is a cash inflow. So we're going to add that. For our total adjustments of $81,500, if we add that to the $64,500 in net income, we're going to get net cash provided by operating activities of $146,000. This number should match exactly the operating section under the direct method. If it doesn't, again, you did something wrong. So the investing and finance sections are going to be exactly the same under the indirect method as the direct method. So you can refer to those sections to complete this. I hope that helps you understand the statement of cash flows. Have a great night.